You want to know why Jay Powell feels comfortable talking about rate cuts, even as the stock market screams to new highs and the doubters everywhere are saying, wow, is he crazy to do this? I say just look at the transports. Do you know that group's now down nearly 11% from its September high? The transports are the backbone of the economy. When their stocks are getting hammered, it's often a sign that we are headed into a slowdown. And within this group, we can't take our eyes off of FedEx. Fred Smith's shipping company has become the ultimate punching bag over the past few months, down nearly 20% from its highs in April. At its peak last September, FedEx was trading at $259. It's now at $162. It's been a brutal decline, but pretty much what you'd expect when there's a downtick in worldwide commerce, like Jay Powell's been talking about. However, FedEx has been around for a long time, and it always seems to bounce back from periods of weakness. While it is a cyclical company, it's a very well-run cyclical. And when the global economy turns, FedEx will turn with it, too, and smarter than it does, smarter than everybody. And that's why you hear so many commentators trying to call the bottom of this thing whenever it's down. It can be a rocket ship. Every time, though, it tries to mount a comeback, something bad happens. And the stock finds itself in the doghouse. So what do we do? What do we have to see before FedEx can give us a sustainable rally? Buy! Okay, first you need to know where the stock is coming from. The recent trouble for FedEx started last summer when the company reported a mixed quarter with not-so-hot guidance for fiscal 2019. Although at that point, Wall Street was more concerned with the size of the company's capital expenditures budget than with a slowing economy. Then FedEx reported solid results in September, so we're doing okay, right? September's looking all right. Even raising fiscal 2019 earnings guidance a bit. But then came the gut punch in December when FedEx gave us another mixed quarter, better than expected sales with lackluster operating income, and management slashed their earnings forecast for 2019. And remember, I'm always telling you that it's the forecast that matters more than the earnings. So analysts cut numbers across the board, and the stock cratered, falling to $150 during that Christmas Jay Powell bear market. Remember, the fourth quarter was brutal for pretty much every international company. We had an escalation in the trade war with China and a clueless Federal Reserve that was aggressively raising interest rates just as the economy was starting to show signs of weakness. That's not a great environment for FedEx. But then right as the new year got started, Fed Chief Jay Powell declared that he was done tightening, and the stock market snapped right back. And FedEx went with it. Now, for a while, it looked like FedEx had its mojo back. But by mid-April, the stock had rebounded to $199, okay? Even though the company actually cut its full-year forecast again when it reported in March. And then May happened. It's May, the brutal month of May. As the trade negotiations with China fell apart and President Trump decided to start escalating again, FedEx stock rolled over. Hey, makes sense. Anything that inhibits trade is bad news for this company, right? I mean, it's a shipping company. But then it became apparent that there was more to it than just tariff-induced slowdown in commerce. At the end of May, Reuters reported that FedEx had drawn the ire, perhaps the wrath of Huawei, the big Chinese telco company. Hey, $100 billion in sales. That's the equipment maker that Trump partially blacklisted. What happened? Well, they apparently diverted two packages that were addressed to Huawei in Asia. Two packages. Huawei is one of the largest companies in China and has a lot of sway with the Communist Party. So there's a looming concern that they'll add FedEx to their list of unreliable entities, which would really damage their ability to do business in their second largest market. Remember, when Fred Smith came on here, what did he say? China is too large to ignore. That was a great visit. We got to get back. Put it all together, and you can see why the stock traded back down to $152 in early June. Once again, though, investors started betting on a comeback. People figured the worst was over, and FedEx managed to give you a decent bounce. Stock climbing to just over $170 in less than 3 weeks. And then once again, those buyers got burned, and FedEx plunged back to the mid-150s the week leading up to the company's latest quarter. I mean, so look, honestly, there is one trajectory here, right? Which brings us to June 25th, when FedEx reported. This time, we got another mixed quarter, although it was mixed in a different way. The sales came in a little bit light, but the earnings were higher than expected. On the conference call, Fred Smith described the 2019 fiscal year as a year of both challenge and change blaming the slowdown in global commerce for the weakness. At the same time, the companies had to spend a lot of money building out capacity to handle all of the demand from e-commerce. Worse, the forecast for the 2020 fiscal year didn't exactly inspire confidence. FedEx opted to give more qualitative than quantitative guidance, predicting earnings per share growth in low single digits, excluding some one-time items. Well, that is pretty bearish, people. Many of us were looking for more than $16 per share. Instead, it might be less than $15. In his prepared remarks, President and COO Rajesh Subramaniam, sorry if I mispronounced that at all, Subramaniam, said 2020 would be a transition year. Uh-oh. That's a term that investors typically hate to hear, especially from a company that's just coming out of a horrible year. We thought 2019 was the transition year. Now we need another transition year? So you think the stock would get hammered, right? Wrong. FedEx rallied on the news, vaulting 2.5% the very next day and tacking on another 2% the day after that. This stock, oh boy, this stock's now run from just under 156 when it reported 2.5 weeks ago to 162 now. Isn't that terrific? Okay. After another strong session today, this is a big deal. When a stock rallies on bad news, it's often a sign that the shares have finally bottomed. At the very least, it usually means that most of the weak hands have been washed out, which is what I think is happening here. Everyone who was going to dump FedEx because they expected a bullish forecast, they're totally out of the stock. You also had a number of analysts arguing that the quarter was better than feared, and management's realistic expectations will put a floor under the stock. I admit that sounds flimsy, but historically, it's been a very effective way to spot bottoms. At the same time, FedEx is dirt cheap historically, as long as you believe the company can meet its own forecast. Of course, the bulls have been saying FedEx is cheap since last year, and it hasn't helped much at all because management has repeatedly cut numbers. But consider this. Over the past 10 years, FedEx has traded 16.4 times earnings on average. The cheapest it's been this past May when it dropped to 10 times earnings. Now, 11 times earnings. That's near the bottom of its historic range. FedEx is as cheap as it's been at any point since the financial crisis. That's got to be worth something. So what's the final ingredient for sustained rally? We need some resolution on the trade situation with China. Some sign that FedEx won't end up on the Chinese blacklist. Oh, and it wouldn't hurt if FedEx can get its act together with the integration of TNT European Express Delivery Company that they bought in 2016. It's been weighing on the numbers for some time. Now, yesterday, Goldman Sachs added FedEx to their conviction buy. Not just to buy, but conviction buy, a very bullish call where they argued that the franchise is too strong to be kept down. Goldman gave us a $200 price target. They think most of the risks already baked into the stock, and it's too cheap to ignore. Maybe Goldman's jumping the gun. I think they're very much on to something. Bottom line, FedEx has been bent. It's been spindled. It's been mutilated over the past 18 months. But when the company issued disappointing guidance a few weeks ago, the stock roared higher. And when you can rally on bad news, that is often a sign that the bottom is in. It's as close as you're going to get to a bell going off. I think you can start buying FedEx right here, right now. If it goes back down, it is so darn cheap that you can just buy more in the weakness. Mad Money is back after the break.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.